One developer, one piece of land, 288 units, built across 5 phases. Matt, this is a deal you've been working on for a long time. And I remember when I first joined, you guys kind of just getting rolling on it. And it's been interesting to see all of the different phases from my side. As it wasn't my project, but getting to watch you do it, the headaches you've had to overcome, all of that. But let's just give people a little bit more of a background on this.
So we funded the first phase 6.5 years ago, but started working on this project almost 7 years ago. So there's 5 different phases. Phase 1 is at 60 units. Phase 2 is 48 units plus the clubhouse. Phase 3 is 72 units. Phase 4 is 48 units, and phase 5 is 60 units. There is one more phase that's coming online here soon. They're going to start constructing, and that's 65 units. But over the years, we've financed all 5 phases so far.
And over those years, how many loans have you done total?
We've done 7 loans total. We're working on 8, and we're working on 9 right now. 8 is to take out the whole project, the first 5 phases to HUD, and the 9th one is to construct phase 6.
Will there then be probably one more once phase 6 is done?
Probably not. That one will
just
probably
because it's the
stick at
last
9.
piece.
Yeah. So first one was probably the most difficult to get through. They came to me. We went through a couple conventional routes first, and then we went to a private lender.
Okay.
That was interesting. They had enough everything was looking great. It was approved through the team, and they sent it to their final approver, which is down in San Francisco. And they go, "Yeah, this is not going to fly. This project doesn't fly for Eastern Washington." We're like, "Okay." We cut us off last minute as we're getting it done. So we went back to the drawing board, started reaching out to more new lenders on this, and we came across a lender that's now funded a couple phases of this project. So they were able to fund phase 1 of the construction. So it was great to be able to get the construction going and get that project rolling along.
So this is a big project, and obviously multiple phases. Why did you guys have to do it multiple phases?
Well, not everybody has enough cash to do 288 phases up front. You look at this total project cost, it's probably somewhere in around the $60+ million to do something like that. You're going to have a lot of money out of pocket, anywhere up to, $15+ million. You're going to have between prepaid equity and everything else. So it takes a while to continue to roll forward from each phase. So we kind of did it in a phase approach. And plus it allows for absorption better of the new units as they come on. So you're not just sitting here with 288 units. Now you got to fill as you're starting to pay your mortgage.
Very true. Because if you all of a sudden have that and you don't get your units paid or filled quickly enough, then you're not hitting cash flow requirements.
Right. Then you're having cash flow requirements on all the cash you had to put in to get the project going.
Exactly. So tell me a little bit more about the people that are behind this deal.
So there's 3 partners behind this. 2 own they're a subcontractor. They're in the construction industry. So they own, and actually their office is next door to the project. And so they've owned the land for many years. And then the other partner on this is the architect and engineer on this project.
Okay. So then they made a pretty good team.
Yeah. So they're owner builder too. That's, the other nuance in this. So they're owner builder. So they have it's nice though, because they have the architect, engineering, and the construction all in house. So they can handle the whole project from A to Z and not have to outsource any of those things besides the subcontractors that come through.
So how did that go with the lenders in the different phases? Has that generally been a value add for them, or has it been a negative at times?
At times it's negative because it's owner builder. Few lenders we worked with in future phases were okay because they also looked at it from a spec project, because multifamily spec, yes, because you don't have tenants right away. So they don't do spec lending, but we were able to, since we were already in the first few phases, they did phase 3 and phase 5. So it was no longer considered spec because we had a proof of concept, right? But phase 1, that was probably the most difficult. And then rolling forward, so we did phase 1. We did the construction, and then we realized the value of it. And where interest rates were at that point, we wanted to tap some of the equity out so we could continue to roll through the phases. We got phase 2 constructing, so some equity there we wanted to tap in, so we refinanced that out. So we got equity out of phase 1 and phase 2. Then we were looking at, kind of prior to that, before we're actually tapping that equity, we're looking at rolling phase one and phase two into one note and rolling phase three and phase four, all with the same lender. So we're going one through four. Everything was going great. We got the approvals through the multiple different channels due to the size of the loan. We're talking about, I think that ballpark was around 40 million. We're going through the different phases. Everything's looking good. And then all of a sudden goes to somebody in Southern California. Literally on the 11th hour, you're really fourth and goal, and they decide to throw it to Malcolm Butler. Instead of handing it off,
Hey,
right?
don't be bringing that back for us Seahawks fans.
But, that's kind of what, all of a sudden somebody just took the ball away from us. We're like, oh, that was unexpected because we had the different layers of approval throughout, and this was again cut off last minute. So we pivoted to the different lenders, different lender for phase one takeout, different lender for phase two takeout, phase three, phase four, different construction lenders. Actually, phase four started before phase three. So people are like, when did that start? Well, phase four started first, then phase three. Why is that? Well, because we had financing lined up on four. We wanted to use that lender for four and switch to a different lender for three. So we were able to navigate through that. And then phase three lender is also the lender that did phase five. Nice thing, the way we constructed the loan is for all the loans, if there is a prepayment, if we're going to take this out to an agency, HUD, CMBS, something that they can't offer, they're allowing us to get out these loans without a prepayment penalty. So we constructed it that way because we are taking phases 1 through 5 through HUD. The advantages of HUD is it's a 1.15 debt service coverage ratio, 35-year amortization, so you get a longer rate. Rates are better in that market by far than you get in the conventional route right now. So it allows better economics for the client, the borrower, so they can access some of that equity and then roll to another project they have working on across town.
So to me, this sounds like if you tried to do this with just one lender, even in the phased approach, you're going to run into major headaches and major slowdowns.
A lot of it depends, size of the lender, because lenders can only absorb so much from a balance sheet. When you're working with local community banks, credit unions, they have limits where they feel comfortable with one borrower on one project specifically too. And when you run into those concentration limits, those become an avenue. So that's why we got to navigate through the different scenes. It's like a big jigsaw puzzle, trying to figure out where every piece goes into that puzzle. And because the ultimate goal is to get our clients, the property built, cash flowing, and then continue on with future developments. So we're trying to navigate that scene with the client, and it's been, great working relationship over the years. So, they ping a lot of things off of us, say, run this analysis. What does this look like? Where are we sitting at right now? So we work through those on a regular basis. It's good to have that relationship where we have a deep relationship with the client and they trust at this point, to get them through every phase.
Well, and then just to even go on top of that, even if, let's say, you had to use different lenders, but then having you guys or having AAI as the single source of truth and relationship over all of the phases, that in the other lenders know that you have the continuity of the understanding of it all. And
they have one person to shoot, which is me, instead of having to shoot. We got 4 different lenders on this overall project right now. They'd have to go worry about 4. So when it comes to annual due diligence, we're able to navigate that for all the lenders because we have it and we can just shoot it out to all 4. The unique thing about this project, since it is a phase project and each lender's got a different phase, when it comes to the annual due diligence, guess what they want? They want the financials for the overall project and they want the financials for their specific phase. Nobody really does their financials like that because a lot of the costs are against the whole project, right? And it's hard the amount of accounting that would have to get to the granularity of, well, this electric bill is for these vacant units. Let's apply it to phase 2. These are for this one. This is phase 4, whatever it may be, from trash to garbage. There's some things that are just overall project costs. So you can't just say landscaping is for those units. How do you break that up? So there's a management accounting that's come into, with my CFO experience, that helps of understanding management accounting. Accounting is great, but management accounting is where decisions are made, and it lets you understand what the phases look like. You know, we have enough information on the revenue side. We know the rent roll is per unit. We know the collections per unit, so we can break it up between buildings, between phases. So that allows us to get the revenue exactly on it. Then you have to use some management assumptions when you're going through the rest of the income statement, P&L statement. You have all the expenses you need to break out. Some are easy. You know, it's easy to say, hey, property tax for phase one because it's a separate parcel is
Right.
this. Those are easy. You know, management fee, again, that's just an application against the revenue that was brought in. So there's some that are easy, but there's some you have to go, okay, this has got 48 units. I only had 44 only had 44 occupied, so we have 4 vacant units. How do we start allocating out all the expenses? So each line item we had to determine what the best management assumption was to allocate that expense item to each phase. So we're able to do that, and we had to continue to do that on an ongoing basis for them and keep that up. So now we got a nice system put in place, and we had the model built in place so we can continue to replicate that year after year for the client.
That's huge because that saves them so much time and
God,
money if they were paying somebody else to do that.
And I get why the lenders want to see that. Like, that's our collateral. How's our piece of collateral doing? I get the overall project's doing this, but how's our specific collateral inside that whole thing? Especially when you have different start dates. You know, phase one started in 2020 and you keep going all the years. Like, now we need to apply the correct, income expenses to each year. You had to apply the correct debt service to each year. And when you have a new phase that just came on, you're like, well, this could hurt the overall project, but my phase might be really good over here, phase one or phase two. So I don't care that phase five is just leasing up because my phase one is doing great.
Right.
So to understand that from that perspective, being on the lender side before lets me go, I know why they're looking at this. They want to make sure they have to take over their collateral. They're going to be in a solid position.
Right.
Is it hitting the metrics? Because they got to do their due diligence, annual requirements, and put that in the file for the regulators. I get it. And make sure they're not in violation of any of their loan covenants. Is the debt service actually hitting that debt service for our specific loan?
Right.
So, there's a lot of nuances that came up with this project, but it's been one of the more, I don't want to say fruitful in the sense of like knowledge and everything we've been able to learn and also give back to the client.
Oh yeah, and the value you've been able to provide. I mean, you helped them turn their original investment into multiples more over the growth of this project.
And it's also allowed us to utilize those models for other projects going forward, for not just them, because they are working on another phase project across town, but also future projects for other clients too. So we're able to use that knowledge and continue to build our skill sets based on this request back in 2019.
Well, and juggling that many different lenders throughout the process, you leaving each one on a good terms, you built that relationship and deepened those relationships with each of them for future projects.
Obviously, nuances of 5 phases and how each lender wants the construction draws.
Right.
And we handle the construction draws. So there's all the nuances. One wants to see all this. They use a third party. And this is how they do it. This one wants it this way. You're just like, okay. So we're able to navigate that over the years for them to make the draw process smoother and easier so they can continue to build on a timely fashion and get their draws when they need. So it's also been a great learning experience. And that's when we really, during that project, is when we started to realize that we need to really own the draw process for our clients.
Yeah. I think that's where we've perfected that process.
One lender might be easy and they go, oh, I can do this for the next one. The next one has a completely different process. Like, and that's kind of what happened. The first phase was kind of easy. Our lender was easy. Phase 2, completely different requirements and completely different things, and got to the point where it rubbed the lender wrong of how the client was doing. So we stepped in mid on that project and said, hey, we'll take over the draw process. I know it needs to happen. Please let us do this. There's no additional cost. It's just part of our ongoing service. Please utilize us. And they did. And they've utilized us ever since, because it's just that much easier when we can control it on their behalf and let them do what they do best, which is go build, go operate this property, go do their day jobs, do those things.
Yeah, and the last thing you want on a project is to have a draw be delayed because it's submitted wrong or it doesn't get approved because...
Or make the lender upset.
Yeah, make them start holding back funds for you.
And then not want to do any additional phases because they're upset about that.
Yeah. And then just learning the different how different types of lenders look at it. Private, I know, looks at those construction draws way differently than a conventional
Yeah. The
construction
nice
loan
thing is
does.
we've been conventional all the way through this project, and there's no need. I mean, they're solid financially. It's been great because like having a home office for these two of the partners right next door, that helps build the project too because they're on site. They're right there. They can access the property anytime. And at the end of the day, they built a very beautiful project, and it's it's nice to be able to remember back when it was just raw land, just walking through the raw land with the client, going and walking through the vision of where they saw it was going to go over the years. And now to go back and look at that reality is like we we helped them do that. That's kind of the rewarding part of what we do. Is I like walking through construction
Oh yeah,
projects
you've seen a finished
during,
project.
afterwards. I've walked up in them and they're half built, and just walking through and looking at them like, this is kind of fun. Like this is, I've seen them putting up the trusses. I've been in there when they've done those things. Just being throughout the process and watch something go from bare dirt to a 288 units, soon to be 353 units, and see that transformation over the last 6 7 years has been kind of rewarding from
Oh
a
yeah,
fill in the bucket on my side.
that's one of the coolest parts about this job is we get to help other people's dreams become reality and feel like we're a part of them, even though
Yeah,
we're not necessarily always partners. We're
I
not.
might not be in their dream, but they're in my dream, I guess.
Yeah. So what? Where would you like to wrap it up on it? What would be the things you've learned from it? Take away.
you know, when you do look at a project, this is all one piece of dirt for the most part to begin with. So we broke this up into different parcels. It doesn't mean you have to phase in a project. It gives you optionality.
Mm-hmm.
I think it doesn't handcuff you by breaking up the parcels and doing all these different parcels. But what it does for you is gives you optionality down the road. I think that's one thing some people miss is optionality. In this world, in this day and age, optionality is the best thing you can do. Is, well, if I need to use it, I can. If I don't, then I'm fine either way. It didn't really hurt me.
Mm-hmm.
As long as you set yourself up for options, understand the pain points that are going to come across, like getting that options available.
Right.
Yeah, you had to go through plat mag and doing all that stuff with the county to get it where you wanted, but you had options, and we were able to break this into 5 phases and 5 different, really, in the end of the day, 5 different loans, 4 different lenders. Actually, we used one lender to build phase one, different lender for takeout, one lender for build phase two, different takeout lender, and then we have 3 different lenders than the others. So we've used 7 different lenders on this project.
Mm.
So it's kind of like, cool, we've done 7 different loans, but 7 different lenders. And that's because we've been able to do that.
It's because you guys have walked through the process one day at a time. And if you had told yourself when you first started working on it that that's what it was going to end up being, you would have probably been like,
no, no clue. No clue that's where we're going to end it up, but it worked out because we built the optionality. And I think that's one thing developers sometimes get ahead of themselves. And the optionality allows you to, if you built through the first 3 phases and you see the absorption's not there, you don't have to rip off phase 4 or phase 5. You don't already have the construction loan built in. You don't have a 5, instead of 5 phases, you have 1 phase, but it can be broken into 5, and now you're like, I gotta build this whole thing.
mm-hmm.
No, you can stop and go, hey, we'll just hold off another year. Let's see how the absorption.
Wait
Let's
until
see
the
how the
absorption
market.
balances back
Let's
out.
see what happens with the market. And so that's one thing I think people miss is you have that protection, but a lot of people want to go pedal to the metal. Let's build the whole thing now and see what happens. Is that the best thing financially? Depending. Every situation is different, but for this situation, it worked out great to have that optionality, and we could pause if we ever needed to pause.
Well, and with this situation, you guys maximized the usage of the initial down payment or your initial equity in, because as that's equity's grown each time, you've retapped it to then to redeploy for the next phases. And I'm guessing they probably didn't have 15% of $60 million project up front.
They didn't have that, but that allowed them to be able to achieve that over time because,
Mhm.
when we first started this phase projects, interest rates were different. What you could build for versus what you could take out for. You can't do that anymore. What you're building for, that's your takeout loan. So it's not like you can typically, in the last couple of years, is go, I'm going to build it for 10. It's going to be worth 16. I'm going to be able to tap up some equity. It doesn't happen as it did a few years ago where I could build it for this and I can go get another $2 million out of
Yeah.
this and still be cash flowing. Why not? And continue to rinse and repeat through it. So that's been probably the one thing that people don't think through is the optionality and really thinking about a project overall.
So a project like this isn't just one financing decision. It was almost a decade, and
Yeah.
better, closer to a decade
Over
than.
half of a decade, 70% of a decade. Yeah.
And the right answers changed every phase, and you changed lenders. You solved problems. You had no's. That's what we do here. I mean, we go on a journey with our clients, and one day at a time. And sometimes we go down paths that don't always work, and we have to pivot and we have to adapt. But what our clients get from us in those type of situations is a teammate that's there with them through it all. So
Yeah, it's been exciting to go through that process and learn a lot, and get to know them well over the years too.
Yeah.
You get to this point where you know them, you know what's going on in their life, they know what's going on in my life, and you build up a friendship, over time, and you start going, hey, I can trust him because that's really what this world is. It's relationships. Someone that's going to be on your side, somebody that's going to go through the thick and thin with you,
Right.
and not just care about what's self-serving to them.
Well, if you guys are sitting on a land and thinking about a phased build, now's the time to reach out to us.
Yes.
Any thing you want to wrap up with, Matt?
No, just always just send us questions, DM us, follow us, ask questions if you have anything. We're here just to give you knowledge too, and let you understand the different ways to do things. There's not always the exact perfect way to do things. So I think that's one thing that people go, oh, here's the box. No, there's a box. There's 45 million boxes. Let's look to see what box is best for you.
Exactly. Thank you, guys. I'm Ben Record, and this is Matt Russell.
Good to see you guys. See you on the next one.